Good morning, ladies and gentlemen. Welcome to the Rural Funds Group financial results presentation for the full year ended 30 June 2022. My name is James Powell. Presenting today will be David Bryant, Managing Director, Tim Sheridan, Chief Operating Officer, and Daniel Yap, Chief Financial Officer. For your information, all participants are in listen-only mode. After the presentation, there will be a question and answer session. If you have any questions, please type it into the field you will be able to see on your screen at any time during the webinar, and we will address these at the end of the presentation. For those attendees who have dialed in via teleconference, press *1 and we can unmute your line at the end of the presentation. Could all attendees please be advised that the webinar, including Q&A, will be recorded. I'll now hand over to our first speaker, Tim Sheridan.
Good morning and thanks for your attendance. I'll start today's presentation with an overview of the FY22 financial results. Firstly, a quick recap of the activities undertaken during the period. During the period, RFF entered into leases for 5 cattle properties and increased the JBS guarantee investment, which provides lease-like income. 2 cattle properties suitable for productivity developments were also acquired. Productivity improvements have been a big part of our strategy since 2016, and RFF is now benefiting from these acquisitions through rent reviews. One such rent review for the cattle property in Natal will provide a 60% rent increase in FY23. Productivity developments are also occurring on cattle properties owned by the group, including a newly acquired cattle property in central Queensland, Bamba Plains. As investors will be aware, a significant focus over the past 2 years has been securing land and water to develop an eventual 5,000 hectares of macadamia orchards. RFM is advising the market today we're in lease negotiations for a portion of these developments, which is subject to an exclusivity arrangement. The next page of this section details the income, earnings and balance sheet metrics for the group at the end of 30 June. An increase in property income of $7 million or 10% has been achieved in FY22. The increase was driven by additional income from the J&F guarantee, acquisitions, development capital expenditure, lease indexations and market rent reviews. Earnings, as measured by total comprehensive income, increased by $86 million in FY22, which is a 70% increase compared to the prior period. This is primarily a result of positive revaluations of cattle properties and, to a lesser extent, almond orchards and water entitlements. Adjusted funds from operations, or AFFO, the net cash generated by the group, was up 9% on an absolute basis year on year. On a per unit basis, AFFO was slightly lower than the prior period because assets added to the development pipeline are yet to generate AFFO. Distributions of 11.73 cents per unit were paid to investors in line with forecast. Looking at the balance sheet, the group's adjusted total assets increased to $1.5 billion as a result of revaluations and acquisitions, both of which we presented later in the presentation. On a per unit basis, net assets increased 24% to $2.69 per unit. Whilst borrowings increased during the period as development capex was deployed by the group, gearing has reduced slightly to 30%, which is at the lower end of the gearing target of 30 to 35%, providing balance sheet capacity to fund further developments. Page 7 details the main components of growth in assets during FY22. The graph on the left-hand side of this page shows these movements grouped by agricultural sector. The largest contributors to the $338 million increase in property assets being from the cattle, macadamia and cropping sectors. As described on the right-hand side of this page, during the year, RFF acquired $179 million of properties, including mature macadamia orchards, cropping properties and cattle properties. Existing properties have increased in value by $134 million, primarily within the cattle sector. And $46 million of development capex was recognised relating primarily to the macadamia developments, but also improved productivity from cattle and cropping properties. The next section will consider the funding sources of these activities. At the start of the previous financial year, $100 million of new units were issued at a price of $2.47 per unit via an entitlement offer. As outlined previously, this equity was used to support the group's ongoing acquisitions and development strategies. During the year, RFF's debt facility was increased from $380 million to $520 million. A third lender has also been brought into the syndicate, and a number of RFF's debt covenants have been revised, including the reduction in the ICR covenant from 3 times to 2 times. We've also continued to acquire additional interest rate hedges, with $210 million of forward-dated hedges entered into during the year. The chart on the bottom of this page details RFF's interest rate hedges over the next 10 years, with hedges increasing materially over the next 3 years. Additional details of RFF's debt facilities are presented on this page. The current headroom of $65 million is sufficient for the near-term development capex requirements, noting the gearing capacity is approximately 110 million, assuming a 35% gearing. While the average cost of debt decreased year on year, interest rates are of course rising in FY23. Before handing over to David to provide a strategy and portfolio update, I'll conclude on this section of financial performance with details of the performance of RFF compared to the AREIT index, as well as the trading price compared to the net asset value. Additional information on the financial results are contained on pages 25 to 31 of this presentation. I'll now hand over to David.
Good morning, ladies and gentlemen. This is David Bryant speaking. Before I continue the presentation, I'll pause on this slide. It has a picture of one of the macadamia properties under development near Rockhampton. In the background is the Fitzroy River and the construction site for the Rookwood Weir, and this will supply water to our Rockhampton orchards once complete. As you can see, it's well underway. RFM has been identifying and acquiring assets that can benefit from 2 strategies designed to increase their capital growth and income generation. The strategies are, firstly, creating productivity improvements, and secondly, conversion to higher and better use. Over the past 2 years, RFM has been positioning the RFF portfolio to take advantage of these 2 strategies through the acquisition of properties suitable for development. The orange properties on the map indicate acquisitions in the last financial year located in central Queensland. RFF entered into or extended leases on 6 properties in FY22. This includes the 20-year lease of 2 properties to lot feeder Morton Co, as well as the 25-year lease for a portion of a cattle property to Clark Energy to install wind turbines for renewable energy production. 4 cattle and cropping properties continue to have their productivity improvements under development, 3 of which RFF will operate prior to seeking lessees. Similarly, 2 mature macadamia orchards acquired during the year will be operated by the fund until a lessee is arranged. These activities are expected to provide additional value and income generation for the group in future years. South of the central Queensland properties are 24 sugarcane farms which RFF acquired in 2020. The map on the right-hand side of this page shows the locations of these farms, which will form approximately half of the 5,000 hectares of macadamia orchards that are proposed to be developed by the group. RFM expects the first 1,000 hectares of this program to be planted by November this year. This slide considers Ladora Downs, a cropping property whose development has been recently completed. Since its acquisition in 2016, RFM has increased water storage capacity by 4,000 megalitres. This is used to support additional irrigated area, which at RFM has doubled to 1,500 hectares. The combination of these two improvements has increased the amount of cotton and other crops that can be produced on the property and improved the consistency of production and the quality of those crops. This provides higher and more reliable cash flows for the lessee and higher rents over the lease term for RFF. As a consequence of these advances, RFF and the lessee have renewed the lease for an additional 5 years. Similar productivity developments are underway on 2 other cropping properties that RFM owns downstream on the Comet River in central Queensland, namely Mainland and Bamba Plains. The next section of the presentation will look at the portfolio impacts of acquisition and development activities. The RFF portfolio consists of 68 properties diversified in multiple rainfall zones, as denoted by the different colours in the map. Agricultural sections in which RFF is invested are also shown. The RFF, the next page shows the FY23 forecasts from each of these sectors. The second chart on this page at the centre presents a breakdown of our lease indexation mechanisms. The bulk of RFF lessees or leases have CPI-linked or fixed indexation. In addition, approximately a third of the leases also have a market rent review mechanism, which seeks to monetise the impact of changing asset values as RFM improves assets through productivity development. The benefits of owning agricultural assets during periods of inflation are well known, and we believe this diverse portfolio of assets with their indexation mechanisms will provide unit holders with the right mechanisms for generating income growth. Looking specifically at the lease revenue generated by RFF, you can see weighted average lease expiry is 9.1 years. Throughout the year, RFM has continued to progress sustainability initiatives and is reviewing the applicability of reporting frameworks, including the Task Force on Climate-related Financial Disclosures. The table on the right shows RFF's largest lessees by asset value and their commitments with respect to the environment. The table notes several lessees are planning to align future disclosures with the Task Force frameworks and have net zero greenhouse gas emission targets in place which would incorporate RFF assets. Before concluding, I'll now cover the FY23 forecast. The FY23 forecast adjusted funds from operations is 10.1 cents per unit. This is less than AFFO generated by the group in FY22, due primarily to higher forecast interest rates, but also interest expenses on developments. Specifically, our forecast assumes interest rates rising to 3.5% by 31 December this year, then holding at that level for the balance of the period. Over the past several years, RFF has acquired development assets which are generating relatively low levels of income. The total value of these assets, including improvements to date, is $261 million. The purpose of acquiring and developing these assets is so that we can lease them out and generate higher, reliable returns. As detailed at the half-year results, cash distributions for FY23 will not increase, although franking credits will be distributed with a value equal to 4%. Forecast distributions have been maintained at 11.73 cents based on a reasonable expectation our macadamia developments will be leased in the near term. This would cause a material increase in FFO and therefore a reduction in the high payout ratio presented here. In conclusion, the Rural Funds Group experienced a very prosperous financial year to 30 June 2022. Profits and asset values increased considerably, while productivity improvements and property developments have created a pool of assets that have been prepared for new leases. The Rural Funds Group has entered this new year facing the challenge of rising interest rates at a time when our larger hedges do not start until FY24. Added to this, at the present time, we have some valuable assets that are not leased. We are confident that FY23 will be a successful year for the group because we anticipate leasing macadamia assets that will provide an uplift in funds from operations for the current year and many years beyond. Beyond 23, RFF will generate higher rents if inflation remains high because we anticipate our interest expenses are well hedged. Our asset values will most likely remain stable as inflation is reined in. And finally, we have more assets to develop and rent. Thanks for attending today. I'll now hand over to James to conclude the presentation.
Thank you, David. We will shortly take questions from participants. By way of reminder, for those that have dialed in via the teleconference, you can select *1 now if you would like your line to be unmuted, and we will be able to hear your question verbally. For those that are using the webinar details, there will be a questions box on your screen, and if you type your question in, we will receive it and answer those after we have heard the verbal questions. I'll now hand back to our operator to unmute the necessary lines.
Thank you. Just a reminder there, *1 on your telephone keypad to queue for a question. But our first question comes through from James Druce from CLSA. Please go ahead, James.
Yeah, hi, good morning, David and team. My first question is around FY23 guidance. Can you just confirm the capital, do you capitalise any interest on the macadamia developments that you've done so far, and the policy for this year, is that to continue that, or is that to expense that as well?
Thanks, James. I'll hand this one to Daniel. Yes.
Thanks, James. We do have a policy of capitalising interest expenses on development assets. So there is some capitalisation of interest being included as part of the macadamia developments.
Okay, is that on the whole, all of the spend or a portion of it? Can you provide any colour on that front?
Yep, sure. So we are able to capitalise interest expenses to the value of our target gearing, which is approximately 35%. So approximately 35% of the development costs, the interest costs on those are able to be capitalised.
Okay, and the interest rate's in line with what your cost of debt?
Yes, that's correct.
Yeah.
Okay, and then you talked about being in exclusive due diligence with a partner for the macadamia orchard. It sounds like it's for part of it. Can you provide any colour as to where that's at, and any sort of feel for the nature of the lease that you guys are thinking about?
Yeah, it's David Bryant speaking, James. The colour's pretty grey because we're subject to confidentiality clauses. It is for a material portion of our proposed development. The bulk of that is underway, and that's the expenses that are being incurred and subject to the previous discussion. So there was a second part to your question, which is, was there a second part to your question, James?
It was just more about just what colour you can provide, and if there's anything about the how you're thinking about the nature of the lease that will be entered into that you can talk about.
Yeah, okay. So they're horticultural assets. If you think about that spectrum of assets that in that diagram that we've had running for many years, whilst there's certainly been yield compression in that dated diagram, it still holds that these horticultural assets sort of fit halfway in that spectrum between natural resource and infrastructure assets. The rental yields will reflect that, and the capital growth and indexation and so forth that you can expect from an asset like that, again, are pretty much aligned with what's expressed in that document. So in that diagram. So basically, at rates similar to horticultural assets is the answer.
Yeah, okay, that makes sense. And one more, if I may, just thinking about FY23 guidance. Are there any other big rent reviews coming up in 23? And also, what are you assuming for just general like-for-like growth from your rental portfolio for 23?
Yeah, no, I don't. There are a few rent reviews, but there's certainly no material ones like the Natal aggregation, which was reviewed this year. So the growth that we will have in FY23, there, as David pointed out, about half of our leases are linked to CPI or fixed indexation. So some of those, so we're assuming sort of inflation numbers in line with the market on those. But keep in mind that leases like the OLEM lease, they don't reset until halfway through the year. So the growth we get out of those that are linked to, say, CPI, we only get half a year's growth for with the higher inflation. But yeah, no material rent reviews this year, but obviously the high inflation will continue the growth in rent.
Okay, that's it for me. Thank you.
Thank you, James. Our next question comes through from James Ferrier from Wilsons.
Good morning, gents. Thanks for your time today. Can I first of all ask you about the Bamber Plains and mainland properties and what your current thinking is or expectations around, where a likely tenant's going to come from and timing there?
Yeah, thanks, James. Look, I think it'll take 1 to 2 years to get those properties into shape so that we can rent them out. It takes time to do development. It takes time to get development approvals. So 1 to 2 years. I would not expect leases on those properties during FY23.
Okay, thanks, David. Second question is around guidance. Can I just confirm there that the guidance excludes, this is FY23 earnings guidance, excludes any potential income that may come through from any new macadamia leases signed? Did I hear that correctly?
Yes, you did.
Terrific. And the second part of the question around guidance is there's obviously some net income flowing through the P&L at the moment from these directly operated assets. Can you give us some colour, please, on what sort of assumptions you've made around that contribution to income from the directly operated assets in FY23 guidance?
Yeah, so because there's a number of moving parts to that, it's probably best to summarise it with a single number, and it'd be roughly 7%, I think. So
10% of the total. Yeah.
10% of the total revenue generated by the group.
Yeah. So and just a little bit more colour on that. So in the case of the macadamias, the ones that we're operating, they're forecast to generate about 5% on the asset values, along with the cropping properties, around 5% on the asset values.
Okay.
And that's through operating income.
Yep. Thanks.
And it's just worth emphasising to the audience that the intention is not to maintain those as operational assets. It's basically to prepare them for leases.
Thank you, David. That's helpful. Last question, just on the exclusive discussions you're having around a lease on the macadamia development. Does that exclusive discussion include the Biwa and Borple orchards as well?
Yeah, I can't comment. I'm sorry. It's subject to exclusivity.
Yep, understood. Thanks for your time.
Thanks, James.
Thanks, James.
Thank you, James. Our next question comes through from Jonathan Snape from Bell Potter. Please go ahead, Jonathan.
Yeah, thanks. Just a couple. If I could first just ask around the tax, the active tax that RFM pays. I think in the first half you included it in the AFFO calculation, and it doesn't look like it's been included in the calculation for the full year. When you're doing the 2023, is it in or out of that calculation?
Yep. So the tax that gets included in AFFO is the cash tax that we are paying out of the group. There has been a change from the half year in that there was no cash tax that had to be paid in the second half of the year, and that's largely due to the timing of the harvest on and the tax recognition on some of the operating the farming operations that we've been conducting during the year. Going forward, what we have included in AFFO is the cash tax that we are paying as part of the group.
Okay, so given it 0 for the full year, does that mean it was unwound from the first half? Because I think it was like 1.2 or something like that in the first half number, if I'm remembering right.
That's correct.
Okay. And if I'm looking at the numbers this year, there was quite a big contribution from Sagara on the properties that you're operating. I'm assuming it's coming through there and just the agricultural produce change. Is the assumption in there that, I really don't want to build a macadamia orchard model for a year or two, that I should look at what you've got this year, farm income plus all the Sagara adjustments against the farm operating costs, and kind of carry that forward into 23? Would that be roughly ballpark? I know you kind of get that 5% number before.
Yeah.
But, I'm trying to figure out how much of it's, where the moving parts are.
Yeah, I haven't done that calculation, but the 5% number is a good number to work on, because you need to keep in mind for some of these farming operations, income from last year may be falling into this year. So there's a few movements. So I think it does increase this financial year. But honestly, the best way to do it is to work on that 5% number.
All right, great. Okay, thank you.
There are no further questions at this stage. I'll hand back over to James.
Thank you, Operator. We've got 2 questions that have come in from other attendees. The first one just pertains to tax statements. They will start to be prepared shortly and distributed to investors now that the audited financial accounts process has been complete. There is another question from an investor in regards to the rental income vis-a-vis the almond orchards and the current varroa mite situation. I'll just hand it over to our Chief Operating Officer to answer that.
Thanks, James. Yeah, I can confirm that there is no rental impact from the varroa mite. We've been in discussion with our lessees, and the leases don't provide for any force majeure events in relation to it, but there is also no impact in FY23 revenue from that event. And the same applies with other agricultural disease risks we have out there. So obviously foot and mouth disease is one that's talked about a lot in the media. Again, we don't have any rent tied to, or any rent reduction that would occur in relation to that. But, obviously those types of diseases can have an impact on asset values as a whole. So, it could have minor flow-on effect, but it won't impact FY23 earnings.
Thank you, Tim. I'll just remind investors that they may submit a question via the dialogue box that they will be able to see on their screen. And just while we're waiting for any final questions, I'll just point out that the pages in the presentation, or the section pages in the presentation, have QR codes, and you can scan those codes to go to a video which is relevant to the image that's on that particular page. We don't have any further questions from our investors this morning, and I know, apologies, one has just come through, and it's in respect to any potential income. Sorry, my apologies. It's in respect to any potential impact of a third La Niña on RFF, and I'll hand that over to David.
There's two questions there from Larry Schlesinger from the Fin Review. Good morning, Larry. So what impact will a third La Niña have on RFF this financial year? There's more money in mud than there is in dust. It's very good for the farming industry in Australia, generally speaking, and so we think there will be no direct impact on our earnings, but we think it'll be very favourable for our lessees, generally speaking. It doesn't mean that doesn't present challenges at harvest time and things like that, but that's the job of good management, to get things to happen and manage through those. And then it's another very interesting question from Larry, which is it your view that rural property values have peaked, given the statement earlier about values stabilising? I think that's an interesting question. Historically, agricultural land values do peak or plateau during the period of readjustment where central banks are raising interest rates to slow down economies. And so that's a statistical fact. During these periods, it's likely that agricultural land values will not increase. And historically, there have been periods where they have decreased. The Great Depression is the most extreme example of that. Our view on our portfolio of assets is that we think that we will just see asset values plateau during this period of readjustment. Once we get through that period, then we would most likely see asset values start to move ahead again and maintain that average historical rate of capital growth of 4.5% to 5%, which is what we've seen over the past 100 or so years. So that's the answer there. And then we've got another question here. Can you talk about macadamia prices, outlook and implications for lessee discussions, or lease discussions, I should say? That's a question from Grant McCasker at UBS. Thank you, Grant. It's a very good question. So macadamia prices have dropped, and we think this is very good news for the macadamia industry, because it confirms that macadamias are neither tulip bulbs or cryptocurrency. They're in fact just a boring old agricultural commodity that where prices go down when there's an oversupply and prices go up when there's an undersupply. And so supply and demand in a commodity that is unsubsidised globally means that we will see typical price movements in response to supply and demand, and that's what we're seeing now. Macadamia's got oversupplied during the COVID period for a range of reasons, and it was most acute in the portion of the nut that is produced that goes into ingredients, and this is smaller nuts and chips and fractions of nuts that do not present well for being sold as whole nuts or as a snack on its own. So that the ingredients portion of production, the price of those declined probably 55%. And talking to marketers of nuts, they're thinking that we're probably approaching the bottom of that price decline, and then one would see prices to stabilise and then start to recover. Whole nuts for larger sizes, the price decline has probably been of the order of 10%, so much less so. But a period of pain like this for macadamia producers generally lasts for a few years because you have a time lag between the crop being harvested, inventory that's being marked down, and so on and so forth. So we'll see this trend of low prices now for a few years. That's negative for the two orchards that the two mature orchards that we produce, so negative for leasing discussions for those. We still expect them to be profitable this year. But it's largely irrelevant or somewhat positive for the development component, which is by far the biggest portion of the capital investment we're making in macadamias, because those trees will start to come into production at a time when prices are back on the rise again, as supply and demand exerts its inevitable forces. We've got another question here. There's a question here from an investor asking if it's getting any more difficult to find qualified lessees or good lessees. No, I don't think so. Certainly the macadamia leasing has taken longer than we would have liked, but we think we've got that well managed. And we think the period of yield compression that we've been experiencing, that may wane now as investors are going to require higher rates of return on their capital as we move back into a more realistic interest rate environment. And I think talking about the industry in Australia specifically, more generally, what we've seen, just, I can give you a perspective over 25 years or over 3 years, but I think it's the same, is that we've seen the emergence of more institutional and corporate lessees, businesses that have become well capitalised and well organised and well managed. Those continue to mature, and they're an excellent source or pool of potential lessees for us to talk to. But we're also seeing the continued reduction in the number of farm businesses in Australia as farms are aggregated, and that aggregation or purchasing of small farms to be added to make farms bigger is occurring with institutional investors like ourselves, but also large family farming businesses. And it's becoming quite common to see $100 million plus farming businesses, and I'm talking about $100 million equity. And that's a trend we've seen over the past couple of decades, as the number of farm businesses in Australia, I think, has declined from 120,000 to 70,000. So the quality of lessees is probably actually improving. Okay, I've got a specific question about macadamia prices. Tim's going to give us some answers to that.
Yeah, okay. I think the current price of macadamias is sitting around about $3.80 per kilo. That's off from about, I think it was $5.75 last year. As David mentioned, that's still, like, even at those prices, our mature macadamia orchards remain profitable at those levels. Keep in mind, our mature macadamia orchards are dryland farms, so they generally yield less than the developments that we're developing. So, they're our mature macadamias orchards that we acquired this year. We probably budget on a yield per hectare of about 3.5 tonnes, and at these prices they remain profitable. The developments we're rolling out, we hope to achieve yields in excess of 5.5 tonnes, so they would be still very profitable at these prices.
Yeah, I'll just add to that, the price that Tim's quoting, $3.80, is the price announced by a company that we will market those nuts through, Marquee, which is a cooperative. they've stated at their annual general meeting that there could be that price could come in at the low threes by the year end. So there's probably some downside, and that's typical of these sort of readjustments. That price is the price per kilo nut in shell at 32% moisture, I think it is. And then there's other ways of expressing it. You can have a kernel price, and kernel prices for large kernels probably dropped, and this is now in US dollars, whereas before I was quoting you an AUD price, so it can get a bit complicated. But kernel prices, as I said, for the large kernels dropped 10%, for the ingredients dropped 55%. So that's probably, gives you an idea on prices. It's just worth emphasising, though, that the mature nut producing orchards, the two that we acquired, Beerwar and Bopple, that we are operating and taking the operating risk on, they constitute about 3.5% of our total assets. So you've got to get this into perspective. The purpose of those acquisitions was to assist us with leasing orchards. That's going well. And the main game is the medium to long term, which is maintaining income growth across a portfolio of assets so that we can continue to increase distributions. There's a bit more of another question here that
I think we've largely, Pete, answered your question, hopefully, but so I referred to the yield where we're assuming, we're hoping to achieve a yield in excess of 5.5 tonnes per hectare for the new developments, and the capital costs that for the developments, they're included in the presentation pack. But happy if I haven't answered anything correctly, Peter, or sufficiently to drop you a line, mate.
Pete, you've added a question there about the Californian drought implications and the outlook for almonds. I'm sorry, I can't answer that.
Yeah, there's no doubt that the drought in California is really starting to bite, I think, from the reading that I've had, and at the moment it hasn't. It isn't putting pressure on the almond price because we've had the COVID constraints for the sales. But I think as we roll into another season, hopefully we'll see some upward pressure as a result of the drought in California. I mean, it's worth noting that California, which is in drought, produce about 80% of the world almond crop. So no doubt if their production declines, we should see increases in prices.
Okay, and then we've got another question from Larry Schlesinger about the outlook for cattle and almonds. I think Tim's probably addressed the almonds. And Tim, you might some comments on the outlook for the cattle industry.
Yeah, it remains very positive. Cattle prices continue to be very high. I think, generally speaking, Australia's cattle herd is rebuilding. It has started that rebuilding phase, and once that completes, we may see prices come off slightly, but that's going to still take another 3 or 4 years for that to occur, to get back to levels that we were at prior to the drought. But seasonal conditions remain very strong, so our cattle producers are still doing extremely well based on the very high cattle prices we have.
And there's been a big run-up in cattle land values, and I think that will plateau now, Larry, because interest rates are going up, and cattle prices are unlikely to go up further. And I'd probably say the same for almonds. I'd say that they will plateau at the moment. And there's been, the last decade has seen a reasonable increase in almond orchard values. I don't see a lot of upside in the near term there either. All right, I'm going to hand over to James to line things up. Thank you very much.
Thank you, David. Thank you, Tim, and thank you, Daniel. We will have a recording of this presentation available on our website, and if there are any additional questions, please don't hesitate to contact our Investor Services team via the details available on the RFM website. Thank you very much.